Hello and welcome to this video tutorial on financial ratio analysis where we unlock the knowledge of finance. My name is Jagdish Parik. In this video, I am going to discuss a very important topic, that is financial ratios. Mainly, I will give an introduction to financial ratios and analysis. What are financial ratios? Financial ratios are created with the use of numerical values taken from financial statements to gain meaningful information about a company. Company's financial statements, balance sheet, income statement, and cash flow statement are used to perform quantitative analysis and assess a company's liquidity, leverage, growth, margins, profitability, rate of return, valuation, and more. To find out about a company's health, we can do financial ratios analysis. So now the question arises that what do we calculate these financial ratios and analyze them? So let me explain this. Firstly, if you want to check the financial health of your own company, then you can calculate the financial ratios to find out how good your company is and what it stands in comparison with the other companies working on the same line of business. Secondly, if you invest in the share market and when you buy shares of a company, it is very important to do a fundamental analysis. And in fundamental analysis, the major part is financial ratios. That is why financial ratios are very important. Financial ratios are mainly divided into 5 categories. These are profitability ratios, liquidity ratios, solvency ratios, activity ratios, and the fifth is valuation ratios. From all these ratios, we get to know about the profit margins, debt position in short and long term, that is, whether the company took too many loans or not, or didn't it have too many liabilities that are unable to fulfill, or how is the operational efficiency of the company, how to decide whether the share price of the company is expensive or cheap. So we can get all these aspects from financial ratios. We will cover all the ratios in detail, but in this video I will give you an introduction that what is the meaning of which ratio and how to calculate them. So watch this video till the end so that you don't miss any important point. Now let us switch to the board. Under financial ratios, the first is profitability ratios. From this we get to know how good is the company in making money. Profitability means obviously it is related to profit earned by the company. So how much profit does a company earns and what are its margins and how fast it makes profit. We get to know about all these from profitability ratios. And we also get to know about the competitive position of the company in the market. And if we compare it with the other companies of that same sector, then how good are its profit margins, how fast it turns around, we get to know all these things. And from where do we calculate these profitability ratios? So you get all the information related to income and expenses from the income statement. Hence, we can calculate different type of profitability ratios. For example, the profit margin is the most common. So, if you divide net profit by sales revenue, you get the profit margin. Everyone calculates this. So, if a company earns a margin of 30%, then naturally it is better than the company who earns 20% profit margin. Obviously, you want to invest in a company whose profit margins are high. That means the higher the profit margins, the better is the company. And if you own a company, you want the profit margins to improve in the future. The second type of ratios are liquidity ratios. Liquidity ratios tells us how comfortably a company can pay its liabilities and loans in the short term. Liquidity is the ability to convert assets into cash quickly and cheaply. Liquidity ratios are most useful when they are used in comparative form. This analysis may be internal or external. Liquidity ratios measures a company's ability to pay debt, obligations, and its margin of safety through the calculation of metrics including the current ratio, quick ratio, and operating cash flow ratio. The most popular ratio under this category is the current ratio. Divide current assets by current liabilities to get this ratio. So basically, current assets should be more than current liabilities. Let us say the current assets are more than the current liabilities. That means the position of the company is comfortable to pay its short-term debts. So, the higher the current ratio, the lesser is the risk. I will talk about the benchmark ratios in the upcoming videos. Now, let us move ahead and discuss the third type of ratio, that is solvency ratios. Solvency ratios are similar to the liquidity ratios. We talked about short-term debt there. Here we will talk about long-term debts. How comfortably can a company pay its long-term debt? Long-term loan fall under long-term debt. Let us say you borrowed loan for fixed assets. So you can check the position of the company by the solvency ratio. We also call it leverage or debt ratios. If I give an example of a popular ratio, it is the debt ratio. We get this ratio by dividing the total liabilities of the company by the total assets. From this, we get to know about the portion of debt in the assets of the company. So, if the debt ratio is 0.85, that means 85% of assets have debt financing. This is not a positive thing because if the debt portion is more, there may be some problems in the long term. Hence, the lesser the debt ratio, the better it is. Because debt is something that kills a company, be it short term or long term. Now, let us move ahead. And the fourth ratios are activity ratios. Activity ratios tells us about the operational efficiency of the company. Then, what is operational efficiency? It means how a company manages its working capital that is current assets and liabilities or long-term assets to increase its production. For example, there is an inventory turnaround ratio. Activity ratios are also called efficiency or asset utilization ratios. So, efficiency comes from operational efficiency and better asset utilization. That means how you use long and short-term assets efficiently to produce more and more. So when we talk about inventory turnover ratios, we calculate it as cost of goods sold divided by average inventory. Let us say the company has T-shirt manufacturing unit. The cost of goods sold means the total T-shirt manufacturing cost in 1 year. Say it is rupees 240 lakhs, means 2 crore and 40 lakhs is the cost of goods sold in a year. And the level of average inventory, if we calculate the average of finished goods, raw material and work in progress, let us say the one-time inventory in that factory is of rupees 15 lakhs. So inventory turnover ratio is calculated by dividing cost of goods sold by average inventory, and it came 16. That means it turns around 16 times, or a T-shirt is being sold 16 times. So basically, you want to produce quickly and then sell quickly. The more times this turnaround will happen, the better it will be. Therefore, higher inventory turnover ratio means a fast turnaround and it is better. So you want your inventory turnover ratio high. In a similar way, there are other activity ratios that tell us about the operational efficiency. And the fifth is valuation ratio. Valuation ratios help you in making an investment decision. Through this, you can find out the right value of the company in which you want to invest. There are different ratios to find this right value. There is a very popular ratio which is called PE ratio. In this, first you find earnings per share. Divide the net profit of the company in 1 year with the number of outstanding shares. So earnings per share is calculated. Then you calculate the PE ratio, which is a very popular term, and let me star mark it. PE ratio is so popular that you will hear about it every time you talk about the share market. So to calculate PE ratio, we divide current market value per share by earnings per share, calculated earlier. Let me write this here. So the lesser the PE ratio is, the better it is. That means the more fair price of that stock is. Hence, if the PE is lower in comparison with the other stocks of that same sector, that means it is better for investment. Similarly, there are more valuation ratios by which you can compare different companies of the same sector. So broadly, you calculate different ratios like this, and you make a decision after checking that a company is performing good, how is its profitability, liquidity. There shouldn't be any problem of solvency in the long term, and if its operational efficiency valuation is good and PE is low, then definitely you want to invest in such a company. So this was about investment. Similarly, you can calculate ratios for your company and you can check how your company is performing in comparison with other companies. So in this video, I introduced the basic of financial ratios and I only shared one example each, but there are many more ratios. We will study all the ratios in detail and will cover in separate videos one by one. Please watch the complete series. So that is it in this video. On this channel, I share finance, investment and ERP JD Edwards EnterpriseOne related videos. If you like my video, please subscribe to get notified of my latest video and share. If you have any suggestion or feedback related to this video or channel, then write in the comments. Thanks for watching.